Welcome to the daily update, where I'll go over the action in the market for Thursday, May 9th, and then we'll see how things look for Friday, May 10th. We had another up day, but there are some concerns that we're seeing that I'll go through as I show the charts and talk about some different things. We have the NASDAQ 100 that is lagging behind, and even to a degree, the mega caps or even the Magnificent Seven. We also have the staples and the utilities, which are pretty strong right now, and those are more defensive areas. Those are areas that typically go up when folks tend to think that maybe we're going to have some problems in the market, or in fact, actually see a decline. Hasn't happened yet. What we're waiting to see is if the S&P is able to go up and set a new all-time high, and we still have staples and utilities strong at that point. That's something that would cause us some concern, and I make note of that later, and I have a couple of charts to show you. But we did have an up day. What was interesting, though, is I was following this, and the VIX was actually positive for most of the session, and then about with 2 hours left in the trading session, that's when the VIX finally turned negative. We're just not seeing a lot of fear in the market right now. But that's kind of interesting to see where the VIX was actually up for most of the session. We're lagging behind when we look at our growth to value ratios, and that's another little concern. But for right now, when you look at all of our indicators, we're looking pretty positive. So let's go back and talk about what happened. We had pretty much a flat open. The futures had spent the pre-market session being negative, and they started to drift higher. And not too long before we opened, that's when they actually switched over positive. But right after the open, prices fell down to the daily pivot at 51.82. Then we were able to climb back above the unchanged level. We got above R1 at 51.98, right around that 5,200 level. But then we hit resistance at R2 at 52.08. Now, the reason why these pivot points are not all that far from each other, even though we've been going up, this is measured on the open, high, low, close, the range for that day. It's not taking into account the gaps from the previous day. So that's why some of our pivot points are pretty close right now. As the day went on, we declined back down to R1. That acted as support at this point. We climbed back above, or back to, and then above R2 to close at the daily high. And that's usually a positive thing when we end up closing out right at the high of the session. We were up 0.51%, so not a real big move on a percentage basis, but we were still up, and we saw a little bit more movement than what we've been seeing before, but we're still well below average when it comes to volume. We're actually seeing volume dropping off even more as we were going up, and that's another warning sign to be aware of. As I typically point out, a lot of folks, they don't really care about volume. They think, well, price is the only thing to pay attention to. And that's true. Price is king, but volume is queen. And so we want to keep an eye on what that's actually happening, because it gives us an idea of the velocity and the conviction behind an up move or a down move. We are positive across the board, short, intermediate, and long term. We have some extreme positive readings, and we're getting a little longer list now. Again, we can take that two ways. Are we overextended to the upside and due for a pullback, or is this just showing good momentum? It's about inflation and interest rates, and we didn't really get much of a read on that. There was some Fed speak that's been going on throughout the week, but nothing that's really moved the markets all that much. We did have a 30-year Treasury auction on Thursday that was well received, and that did give support to the market, and that ended up pushing bonds up and interest rates down. But there's still this debate going back and forth. Is there going to be stagflation? Are we starting to see an economic slowdown because of the employment report? We had the jobless claims come in a lot stronger than expected, meaning more people are filing for unemployment. That's kind of feeding into this scenario that, okay, the last domino to fall, at least right now, that the market's been waiting for, is to see what's going to happen with the employment situation. If that really starts to deteriorate, the unemployment rate goes up and the weakness comes into that situation, then that could signal that things may be turning more negative economically. But we haven't seen really enough to get a trend. We're looking at more outlier type of reports at this point. We just have to watch the story unfold. We also want to keep an eye on the different geopolitical events. Some comments. We did get back above 5,200 with the S&P 500, which had been acting as overhead resistance. Mega caps and semiconductors underperformed. This has been a real leader area of the market, and we went up, and that's positive in and of itself. But the leadership areas are not really participating, at least up to this point. Now, that could change at any time, and they could come in and really take over. The VIX did drop down below 13, but as I said earlier, it was up until the last 2 hours of the trading day. I just glanced at this. I don't follow the VIX all that close. I just kind of look at it. And as the day was open, I just noticed that the VIX was positive. It was up on the day. And then finally, with about 2 hours left, that's when we switched over and started to look negative for the VIX. Europe also had a solid day, so that carried over into the US session. And on a short-term basis, we still have the same list that we've been dealing with of extreme positive indicators. The Stochc RSI, the Williams percent R, the CCI 14 and 20, and the stochastics. Not uncommon to see these even when we're just going up. That's why they're short-term. And this could also be showing good momentum. If you hear a cat in the background, he's just saying hello to everybody. In the intermediate term, a few more things were added to our list now. The CMB composite, we've been above an extreme positive reading now for the third day. And the VIX, based on 9 periods, it's actually going, once it gets going down, it really moves down, even though it spent a lot of the session up. So it's been going down as the market's been going up. We have the S&P McClellan oscillator, which is starting to get into extreme positive territory. Again, doesn't mean that we're necessarily going to reverse. It just means we're getting a pretty high reading. And then the Sean trend meters starting to get up into the upper areas now where we're looking extreme. In the long term, this has been on here pretty much for all of 2024, it seems like. The 150 and the 200 period simple moving averages are still extreme positive. The current scenario, this hasn't changed as of right now, that the Fed will likely leave rates unchanged because inflation has not been coming down the way they were hoping to. They're trying to hit that 2% target, and they're just not hitting it. In fact, inflation is starting to go back up. Any kind of interest rates, the timeline is really uncertain right now. And the Fed is unofficially, they didn't really come out and say this, but they're starting to decrease quantitative tapering. And that's giving support to the market right now because they're actually possibly going in and buying things. The dollar was down and interest rates were down, which did give support to stocks. We closed at 4.45% for the 10-year yield, where yesterday we had been at 4.49%. We are still inverted with the yield curves. We're going to be keeping an eye on those if the employment situation continues to show more weakness. Sentiment, this actually moved for the first time in a couple of days. We're still negative. We have to tick up to 45 to get to neutral, but we're at 44 right now, where we had been at 39 for a couple of days. We're still not trending. The ADX on both the short and intermediate term charts are below 20, and they're below their moving averages, but we are positive with the green line on top. If we see some more follow through to the upside, we see the ADX turning back up, crossing above its moving average, getting above 20, that would show a strengthening trend, but we're not seeing that yet. And I'll show you that chart. With the update, our bias is positive, and our momentum over the last number of days, I've now switched over to completely positive. We had the weekly initial jobless claims, and they came in stronger than expected. We had been around that 212,000 for like a couple of readings. Then we dropped down to 208 for a few weeks. Now it bumped up, I guess 209 is what they revised it to from last time. Now it got bumped up to 231,000, and that was more than the 213,000 that they had expected. And a lot is being made about this, but we'll look at the chart. We'll see what is the trend actually doing with that. We're also declining slightly, actually going up slightly, excuse me. We're going up a little bit with the continuing claims. These are folks that go beyond the first week and they're still unemployed at that point. It came in at 1.785 million. Last time it was at 1.768 million. So here's a chart. These are the weekly jobless claims. And based on the big move that we saw, we really broke to the upside here. And now the moving average is starting to go back up where it had been declining. We're just going to keep watching this. This tends to be somewhat of a leading indicator because it's more to right now of what's happening, even though there's a little bit of a lag with this. It's not as much of a lag as what we see with our other employment type reports. And then we're also starting to go back up with the continuing claims. The moving average is still going down, but we actually crossed back above the moving average. And this gives you a longer term look at what the initial jobless claims, the continuing claims, what they've been doing. And then a week ago, we had the unemployment rate, which is now ticked up to 3.9%. I break that out in a shorter term chart just to make it a little easier to see because we had that huge spike during the whole COVID lockdowns. But these are starting to go back up. Now, they've gone up before only to then start to resume going down. So we can't really tell an awful lot from this. People want to just dogmatically declare that they exactly know what's going to happen. And you just can't do that. You have to let the evidence be revealed, and then we just see how the story changes over time. Here's some Isabel Net blog charts. If you have taken the class that I have on YouTube and then in the courses that I teach that I don't publicly post, I'm a big believer in liquidity, the ability to get in and get out quickly. That's what I focus on when it comes to a lot of the strategies that I implement. Well, liquidity can also really have an impact on the markets. So here it says, the rise in liquidity since the October 2022 lows, that's when we hit the bottom, way back in October of 2022, has undeniably contributed to the upward trajectory of U.S. stocks. And that's what we're seeing here with the red line. Now, it's not just going straight up. It chops all around too. It has been declining. And then you see where we were having some problems. We had the blackouts from corporations because they were reporting earnings, and we had a drop off in liquidity. Well, now this is starting to turn back up. If this continues to go up, will that continue to provide more support? Then we look at the U.S. share buyback authorization announcements through May 3rd. And I pointed this out in Tuesday's video. Last weekend, I had an interesting question of how much do buybacks impact stock prices and earnings per share? I ran across some kind of a figure, I think it was in Twitter, that said 20 to 21%, but there was no data to back that up. So I don't know if that's an actual, something that we can actually rely on. I've been kind of looking for some information about that, but I really haven't found anything useful. If any of you have something that can see what is the correlation between buybacks and earnings per share specifically, which then ultimately goes through the stock price. If you have anything that you look at, please feel free to share that with me. You can either post a comment or just send me an email. I always provide an email address at the end of the video. But it's going down, but it's still looking pretty healthy in this latest reading here. And then this is the US. I show this in the weekend video. This is the spread between risky and not as risky options. I show that chart every week in the weekly video. This is a different look at that same thing where the S&P has been going up on top. And then this shows the spread down here on the bottom. And we're getting to very low readings here. That just means that there's not a lot of risk being anticipated in the bond market. And if this continues to fall, and I look at the chart every day, but I only talk about it usually once a week. And it is continuing to fall for right now. And that could also be positive for the market. Then Magnificent Seven, annual net income and share repurchases. It's going up. Their income is going up, even though they're lagging a little bit behind currently. And then total global debt stock at record 315 trillion. Does 315 trillion even really exist? I mean, does the world have more debt than dollars? There's other currencies, of course, but the US dollar is still kind of the benchmark for the globe. But it just keeps going up, not just in the US, thank you, modern monetary theory, but it's also going up globally. Now, there's probably going to be a reckoning day at some point, and folks are starting to scream the end of the world and doom and gloom. And that may happen at some point, but we just have to go with what we're going now. And again, like I like to say, I'm not a perma bear. I'm not a perma bull. I like to be a perma realist. And there are folks, the things that bothers me about the perma bears especially is no matter what happens, no matter what good news comes out, doom is always around the corner instead of saying, okay, well, things are looking pretty good right now. They may go back in hindsight and refer to that, but they're always focused on the negative. Well, there are some negative times. We cannot not we cannot deny that. There's also 60 to 70% of the time when the market goes up. So that's usually the what we have to default to, because markets over the long period do go up. But there's an awful lot of debt going on and percent of GDP, all this stuff. It's just this is actually coming down a little bit, but the debt number in US dollars has really been climbing lately. Didn't find anything on Twitter. Don't know where we're at here in this cycle. Maybe we're still in this upward thrust. Again, I don't know if there's something legitimate to this. It'd be nice to get an updated chart of this to see where we're going with things. It's just something that I ran across a month and a half ago. It looked interesting, and so I just been putting it here. Here's our daily chart, and you see that we're getting most of the move, at least the last couple of days, not so much in Thursday's session, but a lot of it's coming from the gap, whether we gap up or we gap down. And then the daily range has been really small. So that's why we're seeing the pivot points not all that far apart from each other. We'd had pretty much a flat open as the futures were repairing as we got closer to the open, but we came right down to the daily pivot. We came back above the unchanged level. We went above R1 and we hit overhead resistance at R2. We fell back down to R1. We got back up to R2. And then this is rather encouraging. Instead of coming down as we got closer to the close, we actually broke above R2 and didn't even get close to R3. I didn't calculate it because it would be way up here further. And then to close at the high. So that tends to be pretty positive when we close at the high for the session. Here's our intraday chart. Where in the initial overnight session, we were pretty much flat. We started to see some weakness as Europe opened, and then we clawed our way back, finally went positive, and then we went slightly negative again. Then we had the initial open, and then the pullback that we saw here. And then as things went higher, and we're up just a little bit in the initial overnight session, growth is still above value. The blue line's still above the red line on an intraday chart. That's still holding up on an intraday basis, but we're declining when we look at the ratio intraday between S&P growth to value. That is declining, and again, we want to see this going up for us to have more confidence in that. And the day charts, growth was up, but it was up a lot less than value for the large caps. It was up a little bit more for the mid caps and up, but up less for the small caps. So we're just seeing a little bit of a tick up here with small cap growth to value. We actually saw a tick down with mid cap growth to value and a tick down with S&P growth to value. Again, if we're getting set to go and set new real robust new all-time highs, which might happen, of course, it may not happen as well, but we want to see these values really going up. Then looking at the couple of ETFs, growth versus value, we're actually declining now. We came up to the top of the rainbow and we've been pulling back. Looking at discretionary to staples, this is another area we would like to see doing better than it is. We're still in a longer term uptrend with the ratio, and I'm focusing on the bottom area of this chart. We turned up just a little bit, but we're just not showing any real conviction of strength right now. Large cap growth was up and still above its 50-day moving average, still has a ways to go to get back to its all-time high. The Wilshire was up as well and is looking a little better from a broad market perspective. Our trend, we see the ADX going below 20 and it's below the moving average. That means we're non-trending right now, but we would still default to positive because the green line's on top and the green line is advancing. And this is just because we're seeing a shift from the red line being on top to now the green line being on top. And it takes a little bit of time for the ADX to calculate that. If that ends up happening, eventually it should turn back up if we see more upside from here. We're seeing kind of that same thing with the short-term ADX, where it's declining a little faster below its moving average, but the green line is on top. We're dropping off pretty significantly with volume. And to be going up the way we have been, pretty much all this week. Last week, we were seeing above average volume. We're seeing more follow through to the upside, and we're seeing volume trailing off. And that's, to me, a warning sign. Sentiment here, and it was the ulcer index. And I don't know if you're actually seeing this right now or not, because I had the ulcer index up and it was showing up as a blank slide. But we are seeing where it's coming down below its moving average, just showing how fear has been decreasing as we've been going up. We had the latest reading a couple of days ago. We're at 2.67, so we're kind of in that neutral area right now with the investors' intelligence, and we're continuing to decline with the VIX, both with the line chart and the bar chart. We closed right at the low, and as I said, we were positive for a lot of the day with the VIX. We're getting some very low readings here. Now, you could say, oh no, when the VIX is low, it's time to go. And there are times, but we're in a longer term uptrend. So this can also suggest some pretty good momentum. And with the update, we're starting to come back down with the VIX of the VIX, showing that the volatility of the VIX is continuing to be very low. We haven't had this low of a reading. We bounced up a little bit after Wednesday, but then we came back down after Thursday. For the last year, we haven't seen a reading this low. And the momentum of the VIX continues to decline. Here is the VIX with the RSI showing how fast we've been going. We're just barely getting down to this lower end right now. So not a huge deal. We could still go down a little bit more, but when we start to get around this extreme negative rating, it just shows that the VIX has been declining pretty fast. This is a chart that I wanted to resurrect. I showed it a week or two ago. This is research put out by Tom Bowley, and he just shows what are the returns like. Now, some of these figures are going to be out of date because this was at the end of 2023 when he did this. The chart is up to date as of Thursday's close, but some of the percentages may be off. But when we get down to lower VIX readings, which we're dropping below 13 now, and if we continue to drop, this is when we see the best returns. When the VIX is low, it's time to go. Well, if you went, you missed an awful lot. And then the further up the VIX goes, we do see positive returns, but they significantly drop off. And then when we get above 20, that's where we start to see negative returns at that point. So we're wondering if the low VIX is going to enhance the upward move, or is it just suggesting that maybe fear is getting too complacent and we're due for a pullback? Equity put call ratio. This chart finally updated, and it did go down after Wednesday, and it continues to go down after Thursday. So now we're going down with our 5-period moving average, where we had been going up with this. And that's more positive for the market. We did get the latest reading from the American Association of Individual Investors. They ticked up. They're a little more positive. This is a week old now, but they're not giving us an extreme reading, and the moving average is continuing to be positive. Volatility risk premium continues to drop off, and we're getting very low readings here, showing that there's not a lot of volatility right now, according to this indicator. We actually went up just a little bit with this fear gauge, but we're still declining with this other fear gauge that we follow. Advanced decline line, we're looking a lot better here based on price, lagging just a little bit here based on volume. If we go back and we surpass this previous high, which was an all-time high for the S&P, that would be quite positive. And then if it can be confirmed by volume, that would be even more positive. This is an area that I've been really focusing on, looking more positive. We ticked up a little bit with the new highs, and we fell off, but we saw a real spike up, and then it dropped off, but we still saw more new highs than new lows. That went up again in Thursday's session. So we're continuing to go up with the 5-period and the 10-period. And this is just showing internal strength in the S&P. We are positive with the advanced decline ratio, and accumulation distribution is showing some improvement. We're still above the moving average, and we're continuing to go up. The chicken money flow is positive, not giving real strong positive readings, but it has been green for 2 days in a row, and the moving average is going up. So that's now positive. The chicken oscillator is positive. We're looking better with the cumulative NYSE advanced decline line. And the broader market actually had a pretty good day. With our regular advanced decline line, we're also going up. Here's our other advanced decline line, which is calculated slightly in a different way. It's breaking out above this previous high. And when we look at common stock based on price of the advanced decline line, we're going up based on price as well as volume. So broad market, from that sense, we are looking strong. as of right now. The new highs, new lows for the NYSE continue to be positive, and they're going up. When we look at the cumulative advanced decline line for the S&P based on price, we're also coming back up, getting kind of close to this previous high. Now, where I had been showing that maybe volume was leading price, now volume seems to be lagging price a little bit. We're getting really close to this previous high based on price. We still have a ways to go here based on volume. The advanced decline line studies, we're looking a lot better across the board with the NYSE common stock, S&P, mid caps, and small caps. Short term, we have a pivot point that we bumped into on the daily chart. That could be providing some overhead resistance. And when we look at our short-term oscillators, the Stochk RSI is extreme, the Williams percent R, the CCI 14, even though it declined, it's still extreme positive, and the CCI 20. And we want to keep an eye on the 20-period moving averages. We're well above them. So in this context, we're positive. We still want to see the 20-period moving average go and cross back above the 50-day moving average, and we haven't seen that yet. And looking at the 20-period moving average study here for our exponential moving averages, we're seeing the lines going up, so that's really showing some improvement in the short term. We're going up with our 20, 50, and 200-period moving averages just based on the S&P price itself. The Force Index is continuing to be positive. We're extreme positive in the short-term stochastics, also the intermediate short-term stochastics. We're positive and advancing in the long short-term stochastics. And as I like to point out, the reason I say it that way is this is a further subdivision of the short-term time frame. We're still in the +2 channel with our standard deviations chart, so we're not extreme that way. Intermediate term, the balance of power is looking pretty strong right now. That's positive. The go, no go is still giving us these brown bars. It hasn't switched back over to any kind of blue yet. The highest high value, we're going back up with the blue line. The midpoint is going up as well. That's looking better. The TTM squeeze continues to show that momentum is positive. With our 50-period double and triple exponential moving averages, we're above both lines, and both the blue line and the red line are turning back up. Now, if we really get into gear and start going higher, we're going to want to see the red line cross above the blue line since it moves quicker. CMB Composite, this is the third day now that we've been extreme positive, even though it came down slightly. The 50-period moving average, we're getting a little bit further away from that now. If we do see some significant declines, we're going to be watching either the exponential or simple moving average to see if they provide support. The ease of movement is above zero and advancing. That's positive. The Arun's just kind of, what's going on here? I'm out to lunch right now. We're starting to get extreme when we look at the S&P McClellan oscillator, but it could still go higher, and it could stay up here if we show some good momentum. Or we could get up to this level and start to come down. So the summation index based on price and volume continue to be positive. The NYSE McClellan oscillator is pointing up, and we're not at an extreme reading yet. So the summation index for the NYSE based on price and volume continue to advance. And this has been one of the stronger areas over the last week or so, where the Swenlin trading oscillator has been advancing based on price and volume and not necessarily extreme yet. We're looking better, and we're pretty much positive across the board now with our momentum oscillators. The PMO is turning up, and we're also going up based on price and volume. So we're looking at our studies, the PMOs that are rising, we're almost getting to an extreme reading, but we could stay up here if this is showing good momentum. The buy signals are going up, and we're starting to see the PMOs above zero begin to turn back up. We're positive with the Elder's Impulse system for the S&P. We're positive with the parabolic SAR. We're positive, and believe it or not, actually starting to get a little extreme with the short-term oscillator. Now, we can get well above this green line, and we did that before, and we can stay there for a while like we did earlier in the year. But we just want to be aware when it's getting a little too positive. The MACD is crossing back above zero still and is actually turning positive. So with all of our oscillators, we're positive in the short term, we're turning positive in the intermediate term, and now we have more confirmation of an upward move in the long term with the TRIX and KST oscillators. So we're seeing across the board confirmation now. We're still above all the plotted moving averages, but it would really help things out if the 20 period could get back above the 50 period moving averages. The bullish percent index continues to go up and is above 50. That's positive. And the bullish percent index for the NYSE is also positive. This is a laggard, and this is why the NASDAQ 100 it's doing okay, but it's not leading like it was before. We actually turned down with the bullish percent index, and we're still under 50. The money flow is still positive. The ultimate oscillator is positive. The vortex is positive. RSI 14 and 9, they are both positive. On balance volume is looking better. It's staying above that moving average. And the stocks inside the S&P above their 20-period moving averages, we got above 70. So I have the study on the next chart to show you that, where that's showing a real improvement after we had come down to a really low reading. And this is that study. We just barely crossed above 70. This could be kind of like a ZWAG NYSE breadth thrust, where we get an extreme negative reading, and then not too long after that, we get a reading above 70. And then you can see what happened after that. There was a failure here where we never got to 70 after we had a really low reading, but then it came back down, produced a positive divergence, and then triggered a reading above 70. So we'll see if something like that ends up happening this time. Those stocks above their 50-period moving average were above 50 and advancing. This has been showing some improvement as the intermediate term has been switching back more to positive. And then the 100-period moving average study is going back up, as well as the 200-period moving average study. The Copic curve is positive. The Sean trend meter, we're getting into this kind of, I don't know, you could use different words to describe this color of green, but this kind of lighter, darker blue, no, not blue, but this green area above the red line. How about that? Ichimoku cloud, we're starting to peek our head just a little bit out above the upper side of the cloud. And I want to keep an eye on standard deviation. We are continuing to go up here based on the last 10 periods. When we get above the moving average, that just means that we're moving fast. Again, this does not measure direction, it measures speed. The Pring bottom fisher still generated a buy signal near the end of April, and that seems to be continuing. The mass index, we now have a signal here, and we might want to take this as a potential warning sign. It could be positive, but usually when this is triggered, we came above the blue line, and now we're dropping back below the red dash line. And whatever was happening that made this trigger happen, the mass index is looking at a reversal. So since we were going up, that means that this suggests that we might see a reversal to the downside. We have really no confirmation of that now, other than maybe the NASDAQ 100 and some defensive areas are looking pretty strong, but we're not seeing that based on price yet when we look inside the S&P. Again, there are times when this gives us a pretty good signal. There are other times when it doesn't. So we just have to use other charts to confirm this. Our different charts. When we look at the trend with the Heiken Ashi, we are positive. We're positive with the Kagi chart, positive with the Renko chart, positive with the 3-line break chart. Long term, we are above this R1. And the further we can get away from this, the sooner I will have to stop showing this chart. We are extreme positive with the 150 and 200 period moving averages. And then we look across the broad market. We're positive in all time frames on all different indexes. Now, we're still negative with bonds in the intermediate to long term, where we've turned positive in the short term, and the dollar is still in a downtrend in the short term. No changes on the decision point scorecard. I'm not sure why, because the PMO, we're seeing it looking positive. Maybe it has to cross above the midpoint for that to actually turn and go up. But we are seeing some improvement in the short term, where we're also positive in the intermediate term, and we're still mixed in the long term. And we saw an awful lot of blue. We did have the NASDAQ early on in the day. It crossed below 16.3. But see here, the utilities setting another new 52-week high. Staples, 52-week high. These are defensive areas, things that usually go down when we're seeing growth really outperforming value and discretionary outperforming staples. And then Canada, good for them. They set a new all-time high. Oh, Canada. And we got above 5,200 with the S&P. Healthcare, which is another defensive area, and it's been really weak lately, but it did have a BPI cross above 50. And so here are the sectors. Real estate, utilities, and then down here in about the middle is healthcare. These are not necessarily areas that you would see doing really well if the market is really getting set to go higher. Now, this is a one-day chart, but we have been seeing utilities strong now for quite a while. And we just want to see this played out. Just be aware of these things for right now. Real estate, which was at the bottom of the list yesterday, was at the top of the list after today's session. Tech sector, communication, discretionary. These were three of the stronger areas. They were up. Well, technology was actually down, but these have been the more growth-oriented areas, where these other areas near the top, they're more defensive. So what's going on here? We want to wait to see what develops. We have to go with price right now, and the S&P is going up. Then looking at the equal weight, it's also doing well compared to the S&P 500 weighted index. We came down with the ratio, and this has been chopping around a lot lately too. We want to see some kind of conviction going on here, and we just haven't really been seeing that all that much in 2024. The Dow had a good day. It was up 0.85% and actually closed above this R1 pivot level. The diamonds are continuing to be positive for the Elder's Impulse system, and we're bumping right into this R1 pivot point. This is acting as overhead resistance for the NASDAQ. We're still above the 50-day moving average. We're still in a longer-term uptrend, but we're having a really difficult time breaking above these pivot points. And as I've noted over the last year or so, when you look at the NASDAQ and NASDAQ 100, these both pivot points tend to be quite important, probably a little bit more important than they are for the S&P. They're important for everything, but these seem to really matter for the NASDAQ and NASDAQ 100. And we still have not been able to get up to this R1 pivot point. We're above the 50-day moving average with the NASDAQ 100, but you can see how we've been kind of chopping sideways. We were up 0.16%. So they're lagging for right now. But as I said, this could change. This could change positive and help us break higher. This could break negative and help us, or help things to go lower. But the Qs are still positive with the Elder's Impulse system. The momentum for the NASDAQ 100 is still positive, and we're above all the moving averages here. Again, that would be more positive if we could stay above both lines and see the blue line come and cross back above the red line. Small caps were up, bammed right into this pivot point here, this R1 resistance level. We're positive with the small caps when looking at the Elder's Impulse system, and we're still looking okay, but we're still range bound with the Russell 2000 small caps. We're going up with the RSI. We're above the 50-day moving average, and the momentum continues to be positive. The mid caps came right up to this pivot point, bam, and have not been able to get above that, even though they were up. And the Elder's Impulse system shows that the mid caps are still positive. Apple was up 1%, and it's still above its 200-day moving average. However, in a longer-term picture or view, it's in a downtrend. Tesla was down, and it continues to be in a downtrend, and it's starting to come down a little bit below its 50-day moving average. NVIDIA was also down almost 2%, but it's just coming back down to its 50-day moving average. Microsoft is having a difficult time breaking above its 50-day moving average. Meta trying to make a bit of a comeback, not a real strong move, but still below its 50-day moving average. Amazon did set a new all-time high, at least on an intraday basis when you compare it to these previous prices. I'm not sure if that's a closing high or not, but this has been holding up better than some of the other Magnificent Seven stocks. And Google was up 1/3%, trying to make a comeback after it spiked up, fell back. We'll see if there can be more improvement there. The FANG index, pretty much, it was down, my gosh, 1/4%, but chopping sideways. However, it's still above its 50-day moving average. So I don't know if this lag that we're seeing right now, is that telling us something, or is it the beginning of something, or is this going to rectify itself in a positive way going forward? Because that could change at any time. The financial sector was up 0.75% and still looking solid there. We ticked back up a little bit with our staples to tech ratio. Staples, again, that's one of the areas we want to see that underperforming tech, and it's coming down, but it ticked back up with this ratio in Thursday's session. The dollar ended up being down, even though you see a plus here. This is after hours currently. And the correlation between the S&P and the stocks in the rest of the world, Short-term relationship strong, long-term relationship kind of holding steady to slightly declining. And I wanted to show the staple sector. You can say when you look at this all by itself, it's in a pretty solid uptrend. It bottomed a little bit before we did with stocks. We actually bottomed earlier in October and then have been seeing a pretty solid uptrend. It went down in April like with everything else, but now has been going back. We haven't quite got back to this previous intraday high here, but this is, you wouldn't necessarily see this in a more positive economic climate. And so we just want to see this played out. And then looking at the utilities all by themselves, just the sector, they've just been going up and up and up. So another area we want to keep an eye on, since both of these tend to be more defensive. The total US stock ETF was up over 0.5% and above its 50-day moving average. And then bonds, we were down with the 10-year yield. We were up with the 10-year based on price. We're coming right back up to the 50-day moving average. And we are still going down when we look at bonds compared to stocks. This ratio continues to go down, and that is more positive for stocks. We look at the broad market. The S&P 1500 was shorter-term bonds from 1 to 3 years. That's continuing to go out up above the rainbow. And another broad market measure with further out bonds, this is continuing to move up out of the rainbow. And the market is still favoring a soft landing. We're coming up out of the rainbow with this ratio. And looking at the Qs, which, yeah, they were up, but they just kind of been chopping sideways. But they are coming up out of the rainbow. So maybe we'll see the Qs and the Magnificent Seven really kick back into gear to start to change and look more positive with this. The Eurozone, Europe had a pretty good day, and so we're starting to really come up out of the rainbow when you compare it to U.S. bonds. Home construction, just coming back up to the high end of the rainbow now when compared to bonds. And then comparing cash to 3 to 7 year bonds, this ticked down just a little bit. We want to see this continue to go down if we're more certain that interest rates may be coming down as well. And we also want to see this continue to go down with 1 to 3 year bonds compared to 3 to 7 year bonds. When it's going up, the market's concerned about inflation and interest rates. When this is coming down, they're having more confidence. Then looking at our growth to value ratios, not really seeing a big improvement here, coming back down to the moving average with the Qs to S&P, dropping below the moving average with discretionary to S&P, and actually came down, but still above the moving average with large cap growth versus large cap value. So the large caps actually turned down, seeing more weakness with the mid caps and dropping below the moving average with the small caps. We want to be going in the other direction to be more positive. But this is positive. The 10-day average of the S&P highs minus the lows, that's continuing to go up. And we're still positive with our advanced decline ratio based on price and volume. The new highs, new lows across the broad market continue to go up and are above zero. So that's looking positive now. But this is a concern. We're seeing the S&P to utilities ratio continue to go down even when the S&P is going up. We want to see the S&P outperforming utilities, and that's when it shows more strength, usually. And we want to see the staples to S&P 500 ratio go back down. It ticked up. It had been declining as we were seeing fairly good strength here. There was this time when this was the other Goldilocks period when it was like okay for staples to do well. It was okay. And then everything kind of fell apart from that whole scenario. But we want this to continue to go down to stay more positive for the S&P. So what's our outlook for Friday? We are still positive. We're above the 50-day moving average. That was the real line in the sand, and we're staying above that line for right now. Are we becoming extreme positive, or is that just showing good momentum? The NASDAQ 100 is lagging as mega caps over the last few sessions have not been leading, and we need to see that change to make that go away as a warning sign. We're going to get consumer sentiment, and that's it. Now, it's kind of an important one, but that's all we're getting in Friday's session. As usual, we want to keep an eye on all the crazy things going on to see if they have an impact on the market. Here's consumer sentiment in Friday's session. The 30-year bond auction, from what I understand, did go quite well. So that's what really helped the market. Seasonality, we're neutral to positive with the Dow and S&P, or we're neutral to negative with the NASDAQ. So not really getting any real convicted readings there. We'll be on the 8th trading day of the month, and you can see where we might see a little bit of positive seasonality here. And Friday is one of the more positive days. Friday and Monday are the two most positive days, going back to what happened in 2023. And then after this video, I'm going to shove these over into the weekly video because we're just seeing the same thing here, where seasonally we typically see some weakness in May, but we're just not seeing that develop, at least yet. This is also, I'm probably going to go to the weekly video where we see a decline throughout May. This is also going to go over there. Even if we compare it to 2012, we did see some weakness in May before we saw a bounce back up. This will also get relegated over the other video where we see some weakness on this chart. This will probably go over there too. This is longer term, where on a seasonal basis, we tend to see most of our strength in June, July, and August during the 4th year of a presidential cycle. Tom Bowley, we're still in that negative time for right now and will be until after the 25th of May. So the warning signs, the mass index has triggered a signal. And since the S&P was going up when this was triggered, this may suggest a reversal. Doesn't mean that's going to happen. We're just going to be watching for that and seeing if this is confirming something, because all our other charts are contradicting this at this point. The bullish percent index for the NASDAQ 100, it's still negative since it's below 50. And the NASDAQ 100 has been lagging the other indexes. We'll see if that can change. And then if the S&P makes a new all-time high with staples and utilities staying strong, this could be a warning sign. This is not what you really see at new all-time highs. Now, we don't even know if we're going to get to a new all-time high. But if we keep going up and staples and utilities keep going up, that is going to be a little bit concerning. We have a whole list of positive things. The equity put call ratio based on 5 periods is now back to going down. And then I have our whole list here with our oscillators, the Swenlin trading oscillator, the parabolic SAR, the bullish percent index, ultimate oscillator, chicken money flow and oscillator, the money flow, the vortex, the Copic curve, the momentum for the NASDAQ 100, and the financial sector. So we've got quite a list. And now this is sometimes kind of a warning in and of itself. When you have a whole lot of positive things and the negative list is kind of short, but we're not seeing sentiment. The one thing that would really be telling me that maybe we're getting extreme is if we were getting much higher readings with sentiment. And based on what we usually follow, we're barely back to neutral. We're not even there yet. We're still negative. So our conclusion, we're positive above the 50-day moving average, possibly getting extreme positive. The NASDAQ 100 is leading, and we need to see some more strength coming back in from the mega caps. In the short term, positive, but you could say, are we extreme positive, or is that good momentum? Intermediate term, showing a few more things on our list that are extreme positive, and we're still positive in the long term because we're above the 200-day simple moving average, but you could say we're overbought with our 150 and 200 period moving average study. Thank you. I really hope you found this helpful. I hope you have a great day, and I will talk to you in the next video.